Hello friends, I'm back again with my weekly market outlook video, and in this video I want to raise a contentious basically issue about whether the retail segment, which is by and far the biggest player on the long side, the biggest bulls, is the retail trader actually getting cautious? Are they booking profits? Because by the virtue of their holdings of their long positions, which are roughly 6 times more than FIIs and the prop traders put together, 6 times bigger than them, if the retail guys start to book profits, the markets can actually see some consolidation and correction. So in this weekly video, I'm going to touch upon that topic. Let's dive right in, and like I told you last week, it is the retail segment that was leading the market higher. And if you've been following my social media posts, I've also alerted you about how in the last 2 or 3 trading sessions, the retail segment has been pairing or reducing its exposure at higher levels. So whether the market is likely to make a top or the fact that it might just consolidate sideways depends entirely on the action of the retail guy. And the retail guys have become that critical for the market. And the fact that the retail guys are cashing out somewhat mildly can have an impact on the market. And I will basically help you make an informed decision based on facts, of course, denoted in graphics, which I promise you the studies that I share with you will not be available anywhere else in the public domain. So the roundup window on your screen shows you that the Nifty just about managed to etch some gains on a week-on-week basis, whereas the Bank Nifty actually fell marginally. Bullion was mixed because gold fell, and the dollar strength was responsible for profit taking in gold, whereas silver rose mildly on the back of demand and supply imbalances. Oil and gas shot up. That's the only way to describe what happened last week to oil and gas. They shot up. Now, I've been telling you since months to watch out for these two commodities, and in spite of what anybody tells you, these are what I call multiplier commodities. Therefore, what happens to the price of these commodities can actually trigger inflation and cause lower savings of an average Indian household, which is negative for financial markets. Now, do note in the roundup that even the Dixie or the US dollar index rose, as did the USD INR, which is the United States dollar versus the Indian rupee. This again is negative for emerging markets, including India, and bond yields were stagnant at 6.01% on a week-on-week basis. Coming up on your screen is the MWPL chart, which shows a steady rise in market-wide average open interest, which is a routine factor post-expiry in the new series. Now on the screen, you can see the basis chart, which shows the premium enjoyed by the index futures over the spot. Now this chart shows both indices showing basis contraction. This is partly because of selling at higher levels and partly because of time decay, which is again a routine phenomena. As the derivative series progresses, the basis normally comes down with time. Now keep watching this aspect of the market keenly, because I update it daily on my social media accounts in the late evening, so you can basically update yourself on the fly day after day. My contact coordinates will come at the fag end of this video. Now coming up on your screen are the index and stock futures volumes chart, which covers all 3 series, June, July and August. And last week's rally on the Nifty was on poor volumes, which is a mild concern. The retail guys have been cautious on advances, which is good because excess greed can trigger a crowded exit whenever corrections set in. Watch the impetus chart. Now, this is a study which you won't find elsewhere again, and I've shared with you since the last 2 months. Both the indices are showing a slowdown of momentum, and the slowing down is to the period lows, which is 20-day look back period. Are you then surprised that the markets are lackluster because the statistical impetus is slowing down? Now, our in-house studies track these aspects for us, and I'm gladly going to share them with my friends on social media along with newer studies that I will be sharing with you over time. Now, higher levels may witness some unwinding unless the impetus rises right away. Now, for the studies that I receive a lot of positive feedback on my social media accounts, this is the segment-wise footprint in the market. Let's look at the FII footprint first. They've reduced their index future long positions and raised their stock futures longs to positive territory from a net short position last week. This is a mild positive for the stock market outlook. Now let's take a look at the prop traders. Now these are brokers who are executing on their own behalf, the specialists, and these are people who know which way the winds are blowing, and therefore their trades are very critical for us to watch. They've stepped up their index shorts and reduced their stock longs, but very marginally, which means that these guys are basically playing a cautious hand. It's now time to sit up and take notice because the prop traders are basically exercising abundant caution. Now let's take a look at the most important segment, the retail guys. That is people like you and me. How are these guys playing? Note how the retail traders are stepping up index shorts and at the same time cutting down on stock longs, even though it's mild. The winding down of stock long positions in the futures segment is not very great, but the fact remains that this segment has the biggest open long positions, which is almost 6 times bigger than the others put together, which makes it extremely relevant to note. Is it because the retail segment witnesses oil and gas prices going higher, or is it rising inflation, or even bond yields? Whatever it is, I'm pleasantly surprised to see the retail segment showing ample amounts of maturity when they are seeing rising oil prices and headwinds of resistance from economic data. I will update these graphics every evening on my social media accounts, so there you can get daily updates to keep ahead of the others. This is another one of those firsts which my company has been putting up in the public domain since the last 2.5 decades. Now let's come forward to the 10-year benchmark bond yields. The bond markets were relatively quiet last week, and the yields on the 10-year benchmark paper were unchanged at 6.01%. Forex reserves of India rose past the $600 billion mark for the first time, and the RBI announced the next round of government securities acquisition program, the GSAP, which is slated on 17th of June. In the press announcement, they've also committed to release the GSAP data on the same day, which is a great relief. Last time I had to wait for a couple of days to update myself on this data and then inform you accordingly. So the economic data last week wasn't really very great, but hey, we weren't really expecting surprises. This was due to the lockdown linked to the corona second wave. So the markets took it in its stride. I'll keep watching out for these aspects and update you as soon as possible, preferably every day on my social media accounts. Friends, let's now go to the Dixie, the US dollar index, and the US currency benchmark shows signs of attempting a rally. As we discussed even last week, the index rose on 2 out of 5 trading sessions, with Friday's gains being the most prominent. On your screen comes the daily chart. Note how the index has closed above its 25-day exponential moving average, which raises the probability of the bulls attempting more aggression. Do remember that this currency index triggers inflation, particularly in emerging markets including India, which are import dependent, and a strong dollar hurts our balance of payments. And with rising crude and gas prices, the threat of inflation rises even further. Now, this was another reason why markets fell last week. Coming up on your screen is the weekly chart, which shows the price staying below the 25-week exponential moving average, which means the short to medium term outlook remains under pressure till the US dollar index remains below the 91.5 resistance levels. On the flip side, the 89.5 support is gaining strength, which is a bankable level to watch out for next week. Last week, I advocated a range of 91.15 on the upside and 89.10 on the downside, which held perfectly well. The coming week is likely to witness an estimated, I stress upon the word estimated, range between 91.55 on the upside and 89.55 on the downside. Watch this index carefully in the coming days, my friends. Now coming up is the Bank Nifty, and this banking benchmark index fell 0.69% last week because it rose on only 2 out of 5 trading sessions. The daily chart on your screen shows the price above the 25-day exponential moving average, which means the short-term outlook is positive for now. This index is a far cry from its February highs, which is why it is relatively underperforming the Nifty 50. The weekly chart on your screen shows the price being above its 25-week exponential moving average, but the price is showing a bearish engulfing pattern after the prior week shows an inverted hammer formation. Now, these are signs of weakness in the near term, and the index must make continuous higher highs and higher lows to be able to favor the bulls. That's going to be a tough task. Now, the RBI is likely to resort to GSAP on 17 June, which I already told you. This is something the Bank Nifty traders are going to watch with hawk eyes. And in the week before last, this index was at number 4 of the most volatile list, but fell one notch to number 5 last week. And last week, I advocated a range between 36,950 on the upside and 33,625 on the downside, which held perfectly. The coming week is likely to witness an estimated range between 36,625 on the upside and 33,450 on the downside. I think you should continue to trade light next week on this index due to the high volatility. Friends, let's now come to the Nifty 50, the most liquid, low impact cost instrument on the NSE. And this index managed to gain mildly after rising on 2 out of 5 trading sessions. The price remains above its 25-day exponential moving average, which means the short-term outlook remains positive. The price is at a new all-time high, which means there's very little overhead supply likely to be seen in the coming days. And the high weightage of financial stocks is actually dragging down the Nifty 50, and only a sustained rally in banks along with other index heavyweights will be needed to push this index higher. Note, last week I had advocated that selling would be seen between 15,700 to 15,800, because if you add the previous February highs plus the cost of carry of 4 months from Feb to June, you get approximately 15,700 to 800. This is where a lot of trapped bulls are getting a clean exit. Also, the retail segment is booking profits, which I showed you in the graphics earlier, which is weighing down on the markets in the absolute near term. Now, let's take a look at the weekly chart of the index, which shows a bullish hammer at the peak, which is a mild concern. If the bulls are serious, they need to keep the index above the 15,835 level, which is the previous week's high, to show that they're serious about pushing markets higher. The price is above its 25-week exponential moving average, which means the medium-term outlook is positive. In the week before last, this index was number 7 on the most volatile list, But surprisingly, it slipped sharply to number 20. Now, this is, according to me, a mild concern because this shows a loss of momentum, which is confirmed by the serious loss of momentum on the impetus graph also. Last week, I advocated an estimated range between 16,125 on the upside and 15,200 on the downside, which held perfectly. Next week, we may see an estimated, I repeat the word estimated, range between 16,215 on the upside and 15,375 on the downside. The Jensen's measure is indicating caution, and the risk-reward ratio does not warranty aggressive, fresh, long positions. So I would suggest you trade light if you must and keep a strict adherence to stop losses. Friends, now the indices is done. I turn to the most popular segment of my video, wherein I recommend 5 low beta, low impetus stocks where you take large exposure and wait for small price gains, and 5 high beta, high impetus stocks where you take small exposure and wait for large price moves. So the high beta list is led by APL at number 1, number 2 Pfizer, number 3 Biocon, number 4 Tata Power, and number 5 HCL Tech. The low beta, low impetus counters where you take big exposure, wait for small price moves, is led by Mahindra & Mahindra at number 1, number 2 Reliance Industries, number 3 Sun Pharma, number 4 Mindtree, and number 5 NAM Industries. Now friends, this hierarchy can change day to day because volatility or statistical beta changes hour to hour and even day to day. So do keep in touch with me on social media and update yourself. My contact coordinates come at the end of this video. Also, in the description below the video, you will find links to my videos on Equity Masters channel, wherein I put up 4 videos every week. I update my views out there, and also a link to download a free guide on how to become a better trader from Equity Master. Do avail yourself of this offer. Friends, if you liked my video, do subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comments section, I would love to hear from you. Please let me know how you found this video and all the tools that I have been sharing, studies which I have been sharing with you, which are not available anywhere else in the public domain. I wish you have a very, very profitable week ahead. Thank you for your patience. Do take very good care of your health, your family, your friends, your trades and investments. Thank you for watching my video. Coming up on your screen are my social media coordinates, contact coordinates. I wish you can connect with me. We'll have conversations going and help each other become better traders. Take care. Bye-bye till we meet again next week. Vijay Bhambwani signing off for now. Thank you.